before starting the session, I request all the women CAs to come forward for a group picture. So we will make it a memorable event. So I request everybody to come forward. So we'll take a group pic. Vice Chairperson CA Kavita Ma'am to welcome the speaker. Please put your hands together and welcome our speaker. It's my honor to introduce CA Shwetha as the speaker on the subject Latest Trends in International Tax Law. Ms. Shwetha is a chartered accountant and has a diploma in international taxation from ICAI. With over 20 years of experience in finance and taxation. She is a senior tax leader and has worked in global giants such as Cisco, Amazon, and Harman. Over her 2 decades of career, CA Shwetha has board experience in both domestic and international taxation, M&A, corporate accounting in US GAAP, IGAP, Treasury, and managing regulatory functions including RBI, FEMA, SEZ, STPI. Please put your hands together for the speaker. Thank you.
Thank you for that gracious welcome, Raksha. And I know this is the post-lunch session, and Kavita ma'am has promised 2 extra CPRs if you're going to stay through the session. Is my audio okay? Can everybody hear me clear? Okay, all right, thank you. All right. So what I plan to do today is I'm going to be covering upon a few topics around international tax. While my day job is doing tax, corporate tax for Cisco, I do not intend to bore you with a lot of sections, subsections, case law, citations, etc. I'm going to keep this simple, flowy storytelling format because my objective today is to make you familiar with a lot of concepts around international tax, what makes my day at job fulfilling for me, and what are the areas of concern that I grapple with as part of my day job and which would probably be relevant to you as practicing chartered accountants when you are having your interactions with your clients, or if you're already in taxation practice, probably you will find the concepts familiar. You can probably chime in along to add some experience of your own. So I'm going to keep this simple. I will try not to bore you. If you see me bore you, please raise your hand and I will pivot. All right, so let's start with what is international tax? Maybe I'll just take a couple of thoughts from the audience. What does the audience think international tax is about? Anybody, any brave volunteer? Yes?
The interaction of taxes between 2 or more countries.
Very good.
Any transaction which results in an income to a non-resident which needs to be taxed.
Perfect. Any other thoughts? Is it only about corporate tax? Correct. Withholding taxes, yes. Transfer pricing, yes. Yes, possible. I'm hearing a double taxation, perfect. Yes. Treaty, yes. Yes. So yes, I think I heard a lot of words around which are very familiar, these are the jargons that make my day at work. But what exactly is international tax? International tax refers to, as everybody said, it's a set of rules, regulations that govern cross-border taxation. So when one resident of one country is interacting in trade or commerce with a resident of another country, it creates a cross-border transaction, and the laws that govern this transaction in terms of taxing it create the whole gamut of international tax. Now, what does it cover? Is it only income tax? No, not necessarily. The whole world of international tax includes a variety of taxes. There could be cross-border VAT, there could be customs regulations. Of course, there are a lot more taxes, but today's session, I'm going to keep it focused on corporate tax, because that's all I know. So, all right. So, but why is it important for us? Be it me as an employee of a multinational company, or some of you may be practicing chartered accountants. Why is this topic relevant to us? Because we come across these opportunities of cross-border transaction in a variety of ways in our corporate world or in our practice. And it is important for us to know some of these concepts so that we can advise either our employers or our clients in a way we can optimize the tax impact for them, or reduce the impact of double taxation in case they have to pay tax in India as well as pay their taxes in another country that they are transacting with. This knowledge will help reduce the taxes for them. So this is why it becomes very important for us to be at least familiar with these little concepts of international tax so that we can become a better advisor. Now, where do all these international tax laws emanate from? So from an India perspective, if you were to see, it is going to be with the Double Taxation Avoidance Agreement, DTAA for short, or tax agreements in short, between India and a lot of other countries. There are close to 90 plus agreements that India has signed with other countries for double taxation avoidance. And then the domestic tax law, which is the Income Tax Act 1961, which will soon get replaced by the new Income Tax Bill 2025. Right? So these laws contain the entire universe of double taxation, treaty, WHT, royalty, withholding, etc. So this entirely is the universe of withholding of international tax, basically what I get paid for. Okay? Now let me tell you the jargons that occupy my day at job. Do these look familiar? Anything that is not familiar, anything that's like, oh, who's this new kid? Anybody see any jargon that they don't really? Yes. Yes, true. GAR is new. Pillar 1, Pillar 2 definitely is new. MLI is new. BEPS is almost newish as well. So these are the various concepts we're going to be touching on today. I'm not going to be diving into sections, giving you section references, etc. My objective is to make you familiar with these terms because there's a lot of deep dive that needs to be done to be understanding them in greater detail. And having known these general concepts today, I'm sure it will equip you to probably, if it interests you, to learn further about it. So my objective is to make you familiar. So don't expect the boring sections from me today. Definitely, that's not me. Okay, so what I plan to do today is I'm going to be weaving a little story for you over how international taxes evolved over a number of years. So what started as a classic taxation of permanent establishment, for example, that we learned in our CA syllabus, and how it has evolved from that classic PE definition to over all these newer jargons that you're doing today. So I've basically divided my session into 3 key themes. One is how have various tax controversies or basically the case laws that have shaped the world of international tax. And I'm going to be covering about 3 landmark judgments that have shaped the world of international tax, where even people outside India have become familiar with how India looks at these transactions. So I'm going to be covering a global lens to this as well. Then I'm going to go over how the legislation in income tax has evolved to bring in a whole lot of new jargons into our world. Just when we thought income tax was a tough subject, as one of the audience members told me that they just don't like the subject at all. So just when we thought we just passed our exam, here comes new topics to entice us. So I'll be covering a little bit about equalization levy, significant economic presence, which takes a whole lot of presence in my life these days, MLI, which is like multilateral instruments, PPT, which is principal purpose test, GAR, general anti-avoidance rules. So how these new regulations have made their way into the simple income tax that we once knew. And then going on to a little more unfamiliar territory of international evolution of the taxes in form of BEPS, which is base erosion and profit shifting. As the genesis of why this was needed, why international community had to come together to create a whole concept of BEPS, etc. We will learn that. So it's going to be pretty general. I want to keep it interactive, so if you have any questions, or even if you want to add your own experience around some of the concepts that I'm going to be covering, you're welcome to chime along. All right? And if I'm going too fast, please let me know. If I'm going too slow and putting you to sleep, please let me know as well. Okay? And in the end, when we wrap up, I would just want to leave your thoughts with, okay, we've seen so many complexities over a period of time, so what next from here? Where does the international tax arena evolve? So look at it as a little storytelling in a few slides, okay? So as my first section, I'm going to cover a bit of key controversies around income tax in the area of international tax, basically, where there have been big disputes between taxpayer and the revenue. And as I already in my introduction, they said I am working in the industry side. So most of what I will be speaking today to you is going to be from the industry perspective. So I'm not going to bring in an advisor perspective. I'm not going to deep dive into theses of what that section should read out or look like. But basically how these controversies impacted me and my organization because of these changes. So what takes the top marks in tax controversies today is, for me, is the engineering analysis case. Are people familiar with the engineering analysis case?
This is mostly known as the Samsung case in our
True, yes. Even I was wondering when the ruling came out why it was not called Samsung. Very logical. So the whole controversy on Samsung started very close home in Karnataka, in Bangalore, when Samsung started selling software in the country, and they had to buy the software from an overseas company and make a remittance for it. So then came the taxman asking, all right, you're making payment for software. Guys, you have not withheld tax under 195. Explain to us what's happening over here. We see a lot of money missing from our coffers. So that's where the whole taxation of royalty, taxation of software, it started to evolve. This was way back in 2011. Okay, that I think that's how old I am in this profession. So 2011 was when the whole woes of Samsung started, when Karnataka High Court came out with its ruling that if a company is making payment for a software, Indian company is making payment for purchasing software to a foreign company, it is amounting to payment for royalty. So there needs to be a TDS under section 195. So guys, you have defaulted, please pay up the taxes. Of course, Samsung was not happy about it, right? Because their understanding of software meant that we are only enabling a person to use the application. We are not giving them the source code. We are not telling them how to use the source code to make commercial exploitation. We are always just buying and selling. I don't have to pay any taxes. I don't have to withhold tax on the person I'm buying it from, right? Samsung makes sense, logical sense to me also. That's what I thought. But when Karnataka ruling came out, I was like, really, guys, you want to tax software now? So what happened, Samsung then went to High Court. And similarly, a lot of other organizations who were in the business of selling software, because in those years, around 2008 to 11, the software business in the country was booming. So a lot of software purchases, a lot of distributors set up shop in the country to buy software from outside, like the Microsoft licenses, right? You buy them from an overseas company and then sell them to users, companies who need to use that software in their businesses. So a lot of companies who were selling software got into this dispute, because once a dispute starts, tax authorities know just what to go after. So piles and piles and piles of cases piled up. What also happened is not only did Karnataka High Court give a contrary ruling saying this is royalty, guys pay up, but there were contrary rulings in other high courts. In Delhi High Court, they came up with the thought process that no, there is no source code being given, there's restricted use of the software, so it's not amounting to royalty. Now let's understand what is royalty. For example, I go to a bookstore and I buy a book. I'm not paying royalty for the book, right? I'm not paying the royalty of the book to the person who wrote the book. I'm just buying a book, right? So software is very similar to that. If I'm buying a ready-made software off the shelf software, all I've just done is bought a ready-made product. So how is this different? So those kind of nuances started going into this case law, and a lot of controversies emerged. Piles of cases came over to Supreme Court at the same time, from Delhi High Court, from Karnataka High Court. Finally, it landed in Supreme Court. Supreme Court, seeing a whole barrage of cases land on them, made a clean bucket of four kind of transactions that they were going to cover in this royalty ruling, which is, the lead case is called Engineering Analysis Center of Excellence, but being Bangalorean, I would just like to call it a Samsung case. It's closer home for me. Okay, so this case law covered 4 types of transactions where the computer software is purchased by a resident end user directly from a foreign vendor. Or also covers transaction where Indian companies who are like distributors buying software to sell in India further, but they're buying it from a non-resident seller. Similarly, non-resident foreign distributors buying software from foreign companies, but selling it further to Indian distributors or Indian end users. And then also the logical software embedded on the hardware. So these were the different type of software cases which Supreme Court opined on when it came out with the ruling. Of course, as I said already, the department said, guys, this is royalty, so please pay withholding tax. But Supreme Court, after going through the whole lot of the agreements, the nature of transactions between the parties, what were the actual description of rights and restrictions on those software, decided that the software that were procured either by the distributors in their business of distribution or by the end users for the purpose of use in their business had a restriction, which means they cannot buy and then exploit it further. They can't change the source code. They can't override it. They can't make copies of it. They can just buy it and put it to use in their organization. So once you operate within a framework of so many limitations and restrictions, you do not have a copyright. If I have a copyright, what does it mean? It means that I can do what I want with it, right? If I have a copyright to a story written by a writer, I can make a movie out of it, right? But if I don't have the copyright, then the writer is going to sue me if I made a movie. Similarly, if I place restrictions on the software, it means that I'm only giving it for a limited use without parting with the rights in the copyright. So Supreme Court made the conclusion that this is, there is no parting of rights over here, and as per Income Tax Act, read with the relevant tax treaty, there is no royalty arising in this transaction, so it should not be subject to withholding. So the whole big dispute that ranged over almost 2 decades came to an end. That came to an end finally with this outcome. So happy ending in March 2021 when the ruling came out. But then, practical side of things, did it actually stop the problem? Did the revenue stop knocking on taxpayers? What do you think happened? Vodafone case is relevant, but not for royalty taxation. It's a different gamut. Recovery, yes, but why? Supreme Court already ruled on it, right? They already said royalty is not taxable, so it's supposed to be the law of the land. So what could have gone wrong next? Yes, good point. Amendment happened retrospectively, the famous 2012 amendment. What else? Yes. Yes, in a way that is correct. If in case the transactions are not covered by a DTA, it would still be taxable. That is true. So what happened was, now the revenue became clever. We don't have revenue officers in the room, right? Oh, so the revenue got clever here. So they said, because the Supreme Court ruling was based on reading of those distribution agreements, the customer agreements and those end restrictions, revenue said, okay, now they would go to a new taxpayer, they would look at the agreement and they would start differentiating the facts. I said Supreme Court ruled on this set of facts, and here your set of facts, they don't match. So which means we can't apply that ruling to you. We are going to start fresh proceedings saying we cannot apply the engineering analysis ruling to your facts. You are doing a different kind of a business than what they said because your facts are different. So now you are subject to withholding. Back to square one. 20 years of hard work, gone. Right? So that is what happens. So from when you look at it from an investor perspective or a multinational company that invests in India or sells in India, just when they thought the controversy ended, software companies can now go on their regular business, make money and make money for their shareholders, revenue started differentiating on facts. And even for my own organization today, we are grappling with a whole lot of trying to establish that our facts are just exactly the same as the Samsung case or the engineering analysis case. But then we have to go through the whole cycle of court cases. Go to the tribunal, go to the high court, and then finally go to the Supreme Court. So there's a good outcome on engineering analysis, but definitely not the end of the problem. It's just start of a new problem. Keeps my day busy, right? All right, I'll pause in case you want to add anything from your experiences or you have any questions here so far. If I've been too technical, I'm trying not to be too technical. Good so far? All right. So we'll move to the next one. This is very recent and one of my favorites as well. This is called the Nestle case. Oh, gone are the days when I thought Nestle was just about Maggie. Now Nestle is about MFN. So, I think these are the occupational hazards that you can't associate those fine childhood memories anymore. So every time something talks about Nestle, I don't think of Maggie or the chocolate, I think of MFN. So Nestle controversy happened on a particular clause in the treaty, which is called as the most favored nation clause. So what is the intent behind a most favored nation clause in a tax treaty is if, say, India has entered into a tax treaty with one country, and that treaty has the clause that in future, if India enters into a treaty with another country, say an OECD country or a country that is part of an OECD group, then, and if that new treaty has certain more beneficial tax treatment, either lower rate of tax or restricted scope of taxation, then India will be bound to make sure that the other first treaty should also be accorded the same lower benefit. Right? The countries have agreed to it. It's in the agreement. It's in the DTA. Both parties have signed on it. It's gone through respective countries' parliamentary process to ratify, which means if we have agreed already, it should be honored, right? So what happened? Good, we agreed. So let's take an example of India and Switzerland. India and Switzerland tax treaty had an MFN clause that if in future India enters into a treaty with another OECD country and you give them a lesser rate of tax on anything, say a dividend or a royalty, Switzerland needs to get the same outcome as well. We cannot be worse off than that. That's why it's called most favored nation. Basically, you will give us the same most favored nation tagging like you have given to the new country. Now what happened? India entered into tax treaties with Slovenia. And Slovenia, when it entered into a tax treaty with Slovenia, it was not an OECD country, but it had a lower rate of tax, a more favorable 5% tax rate on dividend income. So which means if the same 5% rate were to be applied based on the most favored nation clause, an Indian company paying dividend to a Switzerland shareholder would have to pay only 5% withholding tax instead of 10% which is in the treaty, which means I get 5% benefit, right? It's quite a lot of money for a multinational investor. But what happened here? We thought it was in the agreement, parties had signed on it, so it should automatically be It's logical, right? You've already signed on it. You've entered into a new treaty. 5% should automatically apply. Logic. But no. Revenue is clever. They have to poke holes in our logic. What happens? So the government says, guys, firstly, you're erring on two things. Slovenia was not an OECD country when we entered into the treaty. It became an OECD country later, right? There goes your logic. Secondly, the way the MFN clause is written up, it says if you're seeing on the screen over there, it says that another country is an OECD member at the time of agreement. So the word of emphasis is, which means when we have signed the agreement, it should already be an OECD member. If it changes its status tomorrow, after we have signed a treaty, from being an ordinary nation to an OECD country, MFN does not apply. Theory number one. Theory number two, what we thought logically, that once a treaty is signed, governments have ratified it through an approval, and it already encompasses a most favored nation clause. It should automatically be on autopilot. No further notification, government process should be needed. No. Theory number two also poked. Government says that the Indian Constitution specifically provides that when Government of India enters into a treaty with another nation, which has the effect of reducing a taxation or limiting the taxation, limiting the rights of a resident, any such amendment should be ratified again. You cannot assume it is on autopilot, right? So obviously, Nestle was at the helm of this. They had withheld only 5% withholding tax when they paid dividend to their Swiss company. And they were not happy with the revenue's findings because they disputed it on two cases. One is on the OECD membership, which happened at a later date, and secondly, on the need for notification. It was, of course, ultra-technical view to get into the fact that a notification is necessary or not. So what happened? Nestle went to the court. Nestle went to the court, and at High Court, they got a favorable outcome. Everybody was happy. Even me and my organization was very glad that Nestle got a favorable outcome. We also started withholding at the lower rate. Logic, right? I have to show a win to my organization too. So what do? I go to my manager and say, hey, Nestle won the case, so we start doing 5% withholding now instead of 10. I'm going to save 5% for my company. But alas, the revenue appealed to the Supreme Court. Once the doors of the Supreme Court are knocked, the Nestle controversy outcome came out in 2023. And it was something, I was in fact watching the live proceedings as well, because it was of so much of interest to me. And the ruling said that the OECD membership happened later, so you guys have erred on the basic fact that the treaty says it should be an OECD member on the date on which the second treaty is signed. It was not an OECD member, so out goes that logic. Guys, not applicable. Secondly, there requires to be a notification by the Government of India if the MFN has to apply. There's no concept of automatic application of most favored nation clause. Every time a most favored nation clause comes, government has to issue a notification to make it applicable. And as you may, since we did not do this, Government of India did not issue a notification, you cannot invoke the most favored nation clause. So on both counts, Nestle lost it, and the whole concept of most favored nation clause and in India-Switzerland treaty was nosedived. And you can imagine what happened to me. I had to go and tell my manager, Nestle lost in Supreme Court, so what we did, we have to unwind. Right? So what does this tell you? It tells you about the complexity and the intricacies of international transactions that we have to pay attention to, right? Even simple decision making like withholding tax at 10% on a dividend income cannot be just looked upon as, okay, we opened the act, we opened the treaty, we applied whichever was lower. It's not simple. I thought it was. Even Nestle was an eye-opener for me as well. So these are the complexities which we will have to look for, make sure when we are taking decisions on withholding taxes for cross-border transactions, we make sure that these little nuances of notification, the entry into force, was it an OECD country, does the MFN apply automatically, we have to pay attention to these little things as well while making those decisions. Now to continue the Nestle story further, what happened? Now, Switzerland, being Switzerland, is not going to keep quiet, right? So what was happening was Switzerland had issued a equivalent of a notification, they call it a statement, in their own country back in 2021 saying that India may have a different view, but we will continue to make sure that if there are Indian residents who are earning dividend income in our country, we will give them the MFN rate. Because MFN rate works both ways. If India accords MFN status to Switzerland, Switzerland has to accord an MFN status to India also. So which means if an Indian company paying dividend to a Swiss company has to be reciprocated with also similar tax treatment for a Swiss company paying dividend to an Indian company. So Switzerland was continuing to give a lower rate of 5% to Indians who were earning dividend income in that country. But India was not. So Switzerland, once this ruling came out in October 2023, just a few months ago, issued a statement, not a few months ago, maybe a year ago almost, said that we are going to do a retaliatory action, guys. If you are not honoring the MFN from India side, we are going to make sure we are not going to honor the most favored nation clause for your residents if they are earning income in our country. So we are also going to suspend the application of MFN from our side as well. So today, if any Indian resident is earning dividend income from Switzerland, has to pay the higher rate of tax as well. So this is retaliatory action that came out as a result of Supreme Court's ruling on Nestle. Anything, any experiences to share, any questions, thoughts?
What happened to the fact that notification has to be issued? So, has the Indian government started issuing notifications?
Not in this case. The government probably did not never intended to honor the MFN. So the notification on Swiss has not come through at all. So MFN has got suspended on both sides. So we have to pay the normal rate of tax of 10% on dividend. So how's it going so far? Am I too fast? Am I boring? Okay, thank you. Okay, let's go to the newest one now. This is just almost like just a few months old. This is called as Tiger Global International. Maybe what you would relate to this is, this was one of the investors into Flipkart at a point in time. Okay, this case is going to be about how the tax disputes create an uncertainty for the taxpayer. So I'm going to be talking about the roller coaster ride that Tiger Global International had in India as a result of one of its investments that is divested. So coming to the facts of the case, we may not be all so familiar with it because it is so recent, is Tiger Global Holdings was a Mauritius-based organization, a private equity firm which invests into companies. Okay, so they had invested into Flipkart Singapore, and as we know, lately Flipkart, Walmart bought over the Flipkart's business, right? So what happened in 2018 was Tiger sold its investments in Flipkart Singapore to Walmart. Now, why is that relevant to India? Next question, right? So Flipkart Singapore had substantial value of its shares from Flipkart India. And we all know the indirect transfer rules, Section 9, which came with retrospective amendment from zillions of years ago, right? So if the shares in Singapore were having substantial value from investment in India, which was Flipkart India, which means when Tiger Holdings in Mauritius is selling its shares in Singapore, it is as good as it is selling an investment in India, so it will be subject to a capital gains evaluation. And based on that evaluation, they used the India-Mauritius Treaty, which had a grandfathering clause. Now, what is a grandfathering clause? Grandfathering clause said that if any investments made prior to 1/4/2017 are divested subsequent to that date, they will be protected from any capital gains tax, because back in the days, India and Mauritius had a very favorable tax treaty, and capital gains was not taxable in the older days prior to 2017. The treaty changed in 2017. So what happens to create certainty for investors? Every treaty will have a grandfathering clause when there are amendments. So if there are transactions which are entered before the date of an amendment, they usually get grandfathered. Grandfathered means we save them from the new impact. So Tiger invoked the grandfathering clause from the India-Mauritius Treaty, saying this is an investment we made prior to the amendment of the treaty in 1/4/2017. Therefore, we will be exempt from capital gains tax. Now, to get further certainty, they approached the advance ruling, authority for advance ruling, and made an application. Advance ruling is a process where you will apply with your set of facts to the bench and ask them what the outcome will be, so that you can get certainty on it. The AR outcomes are binding on the revenue. But AR ruled unfavorably. AR said, guys, you are running a sham operation, right? There is no substance to your Mauritius entity, so you will not be entitled to the treaty benefit. So the whole concept of treaty benefit is based on the fact that the transactions are bona fide. You are a valid resident of Mauritius, you are running a well-oiled operations, you're not just a post box company. You actually have operations, and then you get entitled to treaty benefit. That's the ethos of any tax treaty, because we want to make sure that when tax benefits are given, they are given to bona fide transactions. Both parties to the treaty are eligible for the benefits, and they are not just using a treaty to gain an undue advantage or unfair advantage or tax avoidance. So the ethos of tax avoidance have to be applied with. So AR said that your transactions appear to be sham to us. You have no substance in Mauritius, and you're just here treaty shopping. Tiger, of course, was unhappy. They went to the High Court, saying that we've been unduly denied. They filed a writ petition. Once you get an unfavorable AR, you have the option to go to High Court. You don't have to go through the tribunal route. You can short circuit to the High Court. So they went to the High Court, and they filed a writ petition saying, we have got an unfair ruling from AR. Please look into it. They haven't given us what we thought we were entitled to. High Court did a very thorough check of the transactions, the documents, etc. And the facts that emerged was Tiger Global was very well-established operations. It had legitimate business. It had a valid TRC. TRC, as we know, tax residency certificate, is an important document to be able to claim treaty benefits. Okay, so they had a TRC as well, which means Mauritius government has legitimately announced them as a tax resident of Mauritius. And once a company has a TRC, it means that they are bona fide. Their country recognizes them as a tax resident. So who's India to question it, right? Once Mauritius says they are legitimate, what business does Indian revenue have to poke holes in that theory? So High Court said, okay, they are legitimate business, they have a TRC, they have demonstrated that they have satisfied all the conditions of the treaty. So High Court did not find any reason to claim this transaction was a sham or a tax avoidance. So they were legitimately and bona fide eligible to claim no capital gains tax based on India-Mauritius Treaty. So we uphold Tiger Global International Holdings view that there should be no tax on the transaction. Now what happens? Naturally, revenue is not happy. So they have gone to the Supreme Court. So the final outcome from Supreme Court is still awaited, but there has been a stay that has been granted by Supreme Court in the interim, which has put a which has put an embargo on any implementation of the High Court ruling on Tiger, which means Tiger went from AR nosedive to a uphill upholding of High Court, a win for them, now back to a stay, which means they still, after these many years of the transaction happening, there's no certainty. So to me, as somebody who's going to be investing from outside India into India, gives me a picture that there's so much uncertainty in the tax environment over here, right? One court holds us up, one court sends us back home with a loss, and then there's a stay. And what happens? We still don't know what is the outcome. We have to wait another few years before Supreme Court rules on the actual technical merit of the case. Right now, this is just a stay till the case is heard on its legal merits. So, as an investor of a multinational company wanting to invest in India, does not give us a good certainty about the tax environment in the country, right? So these are the things I would look at if I were to make investment decisions for my organization, as if my organization, say from Mauritius, wants to invest in India, these are the things I would look at. And I would probably tell them, no, the Mauritius route is uncertain. We will have to prove a lot of despite having legitimate business, we will have to go through a lot of evidence checking, etc. So let's avoid Mauritius. Can you bring the money through a different country? So these are the points that become important to us. So I'm leaving you with these thoughts that, the things that you would want to see if you were on the advisor side advising your clients, and the points that advisor would want, the client would want to be relating to, right? So this is an interesting case, a very recent one, January 2025. So just almost hot off the press this is. Any questions, anything that I did not clearly explain? Please go ahead. Very good question. The question is, since the litigation has not concluded, how does a company take tax positions? Definitely, as I said, this creates uncertainty. So if I were an investor wanting to invest via Mauritius, I would make sure on several counts that I have a valid TRC, I'm fulfilling all the bona fides of the transaction, I'm not running like a shell company over there, I actually have operations. So all the care-abouts that were discussed in this case, I would make sure that for the next investment, I would make sure necessary evidence, documentary paperwork is put in place, I'm able to demonstrate substance. But despite that, am I in the clear? Possibly no. There's always uncertainty. Any other questions? All right, now I'm going to move to an interesting fact, okay? Have you heard of Cayman Island? Yeah? So Cayman Island is a cluster of 3 islands, 3 tiny islands in the Caribbean, okay? Which has wonderful world-class resorts. And I always thought Cayman Island was a tourist destination, right? But this doesn't tell me that, right? Besides being a famous tourist destination, Cayman Island is also a tax haven. And why is it a tax haven? Because it has no taxation for its residents or non-residents operating out of Cayman Island. Oh, the tax person in me is giving me ideas. I have to make sure my company makes its next set of investments through Cayman Island. And this building is going to be my registered office. So interesting fact, in the media as well, this is a 10,000 square feet building in Cayman Island, and it has close to 20,000 companies registered in it, which means 2 companies registered for every square feet area of the building. So like, yeah, this is one company, and this is another one. But what does it tell you? The jokes apart, what does it tell you? Yes, I'm hearing a lot of tax avoidance, right? So they would resort to like a treaty shopping. They would want to make sure if they want to invest in a high tax jurisdiction, they want to make sure it goes through a low tax jurisdiction so that when this country makes a royalty or dividend payment, it does not get taxed in Cayman Island. So this becomes like a treaty shopping avenue. And that is what Cayman Island is notorious for, besides being famous for its 5-star resorts. Okay? So with this, I will segue into the next stage of evolution, okay, as to how our legislations evolved. Okay. So our legislations also evolved with the increasing tax avoidance strategies adopted by multinational companies, by a whole lot of, and this was also the time the digital economy was booming, right? People could do business in the country without actually having physical presence in the country. For example, Google. Google could place ads in the on their whole Google AdWords ads program without actually having any substantial presence in the country, just on the internet, right? So a lot of this evolution of digital economy gave impetus to creating provisions in the Income Tax Act to make sure, firstly, all the digital economy, digital companies which are making money in the country without having set up shop or subsidiary or any kind of presence in the country, they needed to be taxed. How do we tax them? In comes equalization levy, right? A fancy word that made its way into our jargons in 2016. Now, equalization levy is actually not even part of the Income Tax Act. It is part of the Finance Act 2016. So they kept it out of Income Tax Act as well. And this required that if an Indian resident was taking any advertisement services from a non-resident, online advertisement, like ads that you see in Google, Facebook, Insta, all those are online ads. The targeted ads, which the moment if you have searched Cayman Islands on Google, next time you open your Insta, you will see Cayman Islands, right? Those are targeted ads. So when an Indian resident company makes a payment to a non-resident for online advertisements, the Indian resident is supposed to withhold a 6% withholding tax from those payments and remit it to the government. It is not TDS forms, it has its own set of equalization levy, has its own different compliance. Now what happens? If I am an Indian company and I'm making a payment to Google and I'm going to withhold tax, Google, is it going to listen to me saying you, instead of paying me 100, you pay me 94? No, it won't. It says, I don't care about equalization levy, I need to get my 100. 6% you have to remit, it's your obligation, you please remit on your own. So what happened? A transaction that was previously costing me 100 is now costing me 106. So what it did was it did not tax the non-resident. It actually put the burden on the resident. Because most multinational of large sizes have that negotiating power. They can get to the table and say, my way or highway. Right? So Google is not going to be taking the 6% cost or Meta. They are going to put it back on the resident, and it increases the cost of transaction for the Indian company. So nobody got wiser after this equalization levy. New taxes, but I don't think it met the objective it needed to. And I saw that there was another newer version of equalization levy that came as a 2% on e-commerce supplies. A few years later, it quickly got unwound and it's found its way back as well. It disappeared from the horizon. The next kid on the block was significant economic presence. As I was talking about the whole virtual digital world opening up, digital economy, people were able to sell in the country without setting up shop. Government introduced significant economic presence into the Income Tax Act, into Section 9. A new section for us to read when we are studying for the exam. So this was basically called the virtual nexus rule. Basically, if you don't have a shop in the country, but if you're a non-resident selling goods or services in the country exceeding worth INR 2 crores, or if you're if you are continuously interacting in the country with users. So you can imagine something like Facebook and its users, and as a result of that, you're generating revenue like ads. You will be covered under significant economic presence, virtual PE rule. Now the saving grace is this regulation exists only in the Income Tax Act. And as we know, for something to become taxable on a non-resident, if they are in a country where within India has a tax treaty, the treaty does not have this definition of a significant economic presence. So they still will not be taxable. So as a tax planner for my organization, what am I going to do? I'm going to make sure that if my company is going to be selling in the country, it does not sell from a country with which India does not have a tax treaty. Because if it does that, it will get caught under the significant economic presence. So these investment destination thought process as both from an industry perspective for myself, from advisor perspective for those in the practice, will become important to advise the client that the choice of the country will become important, because we are better off with a country with which India has a treaty than be caught under the significant economic presence bucket. Then the next evolution that happened to bring more jargons into our lives were multilateral instruments. Now, as we discussed, the whole world was grappling with how to arrest these treaty shopping, tax avoidance, people coming through this Cayman Island type of treaty shopping destinations. So what does the whole world global community do? It comes with a BEPS program, right? So the BEPS program, with the consensus, I'll cover a little bit of BEPS background in the next slide, but this is just a little bit of teaser for you. That BEPS program, the whole OECD G20 community came together, and they came to a consensus that we need to agree that when we are having our treaties, the treaty should have a concept of principal purpose test, which means that if your principal purpose of entering into a transaction is to get a tax benefit, then you are not entitled to the tax benefit. You should have bona fides. Your transaction should have a commercial rationale. You cannot operate from a Cayman Island 2 square feet area and claim a treaty benefit. By the way, India does not have a treaty with Cayman Island, so not a good destination. Okay, so you need to have a commercial rationale to your transactions. If I am paying, say, royalty from India to a company outside India, and that country in that country, that person who's a beneficiary of the royalty has no operation. He just has a post box company. No office setup, no people, no infrastructure, no wherewithal. It gives you that thought that, okay, they are in this country only for tax advantage and not because that country has the resources for this talent. It doesn't have the wherewithal of a royalty. It probably doesn't even have a copyright registered in that country to get a royalty. So they have chosen that country as a destination only to take tax advantage. So the MLI, multilateral instrument, is like a top-up document to an existing tax treaty, which the countries to the BEPS program have to sign through a whole process of ratification, which includes a principal purpose test. So this is like a minimum standard which has to be agreed in the multilateral instrument. So multilateral instrument just sounds fancy, but it is just another top-up protocol to a treaty. Just imagine it to be in supplementary to the treaty, simpler version. So every country has to sign up to the principal purpose test so that we can avoid granting treaty benefits to transactions that lack bona fides. Okay, so these were the new concepts that came over the last few years into the into our domestic legislations that we had to take care of. Other things were also happening in parallel. GAR came into our world. Who had heard of a GAR before, right? New jargon. So GAR came into our lives. Again, this is also an anti-avoidance rule. So you're getting the drift, right? So the world has moved from investing into a company, into a country for economic reasons, to choosing their destinations just to avoid tax. So somewhere along the way, the commercial rationale took a backseat, treaty shopping took the front. So the countries were worried. Okay, if this is happening, then a lot of countries are going to be losing revenue, because if treaty shopping happens, people choose favorable treaties only to reduce tax. Those countries, those governments are going to be getting lesser revenue. So each country came with its own variations of anti-avoidance rules. So GAR is also very similar to principal purpose test, but it's the Indian, it's what is in the Indian Income Tax Act. Uh, and here the only difference between GAR and MLI is in PPTs. PPT says if one of your purposes is to take tax advantage, which means it's much more broader. GAR says if your main purpose is to take advantage, you do not get tax benefit. So if you met the PPT test, you automatically meet the GAR test, right? So you don't have to worry about passing 2 tests. So GAR came with this very little practical experience I can share with you for GAR, because this is still emerging. Not much is there in terms of case laws and tax disputes, and I myself won't be able to quote you practically where Indian income tax authorities may have invoked GAR on a particular transaction. I'm aware of one specific transaction in Andhra Pradesh where GAR was invoked on a domestic transaction actually, where certain bonus shares were allotted to preferential shareholders, etc., for zero value. And there was a subsequent sale of those shares, and the authorities were not able to get a comfort on commercial bona fides of those transactions, and GAR was invoked. But the jury is still not out on it, so we've not seen the last of it. So this is how the tax legislations in India are also emerging. Then on one side, we're trying to arrest these tax avoidance, making sure commercial rationale takes front seat. And on the other side, government's coming with a lot of tax incentives. And this is the other part of the government that wants to get more investments into India, entice the multinationals to start manufacturing in India. For example, Apple started manufacturing the iPhones out of India. So similarly, a lot of schemes that are getting introduced, such as PLI. PLI is profit incentive. So if you're manufacturing in India through a local manufacturing unit, you are under eligible manufacturing criteria, you are eligible for a profit-linked incentive from the government that starts at 5%, and over the years, over 5 years, it reduces if you met your export of revenue target. Then there came the gift city. Gift city was, I think, a novel concept. Anybody heard of the gift city in Gujarat? Yeah, very novel concept. This gift stands for Gujarat International FinTech City, right? And what does it do? Sounds very fancy. What does it do? This is a hub for financial services. So it could be, you could have GICs, investment hubs happening over here. So it's basically a special economic zone, but for financial services and elite services of that category. So as a result of this, if you are setting up a unit in Gift City, you have advantage of income tax exemption if for that unit, so no corporate tax for 10 years. So there's a corporate tax exemption. Then investors into that company, the shareholders, they are entitled to a concessional tax rate. So if they are earning interest from any financial transactions happening through the Gift City units, they are entitled to a lower rate of tax as compared to the Aam Janta. So these, while on one hand, all these newer jargons are coming into our life, on the other hand, the government in its vision to do Atmanirbhar, Viksit Bharat and all that, a lot of newer incentives are making their way into the Income Tax Act. So I'll pause for any questions or any thoughts that you want to share.
So any planning that is actually done this, there is an uncertainty attached, irrespective of whatever.
No, I don't think any amount you can only do so much planning as the current laws are applicable. So
True.
is
True.
there anything to? I don't think so. There is any solution as yet to kind of work around and plan your taxes better.
Yes, so absolutely true. There's always uncertainty because moment you have taken a benefit of some kind, be it lower taxes or you've taken a more favorable treaty jurisdiction, you are under the lens. So what we have to ensure, either when we are advising the clients or as from the industry side, that we are evidencing those decisions with a commercial rationale that we needed to do this specific transaction because that was the rationale for the transaction. Commercially it made sense to us, not because it was a favorable treaty destination or it was a lower tax transaction. So if we are able to have that robust documentation, we will ultimately prevail. But does that do away with litigation? Possibly no. Litigation is bound to happen.
I have a query on equalization levy. When we say advertisement or space for advertisement, it will be usually in the form of subscription. So how do you practically bifurcate, like can we call it as advertisement or it is general subscription, like for example say LinkedIn?
Example?
LinkedIn. For employers, they provide space to advertise for employment and everything, but it comes with several other things also.
Okay, a good question actually. So I would distinguish this to be advertisement in the nature of, for example, when you open your LinkedIn, you will see some sponsored ads on the side. Even when you open your Amazon shopping website, you see some targeted shopping ads on the site, right? Where people have paid to buy that slot. So equalization levy is intended to capture that market, not the subscription revenues. Because with subscription, advertisement is possibly a consequential benefit you are getting, but that's not the main benefit. But in a actual targeted sponsored ad, people are actually buying that slot. When you open Facebook, besides all those feeds of the day, you will also see one tourist ad, one new fancy shopping, one new handbag for the women. They know, they understand women better. So they're going to see everything that we shop for and going to target us. So that space that they buy, the advertiser buys to put their product on, that is the target of the equalization levy. So if an Indian company, for example, let's take Lavi. Lavi wants to put its bags on Facebook when the people browse through certain pages. So when Lavi is going to pay to Facebook, to Meta, Meta is housed in Ireland. So if it makes a payment to Ireland for getting this space for its bag, it will have to make sure 6% equalization levy is paid on it. It is for everyone, other than individuals. Other than individuals, yeah.
Excuse me, ma'am. Yeah, so my question is also on equalization levy. So as you mentioned that mostly vendors and advertisers are not ready to get this deduction, and most of my clients into digital marketing. So when they pay, so mostly they have to pay from their pocket, that
Yes.
6%, and mostly payments are happening via PayPal or other revenues. So like then how we will deduct that? So always we will pay from our pocket.
Yes, even if you wanted to deduct, I don't think any of these global MNCs are going to let you deduct.
Yes.
Yeah, but procedurally, if you're going to make a direct payment via any of these online
PayPal,
channels, then you will have to get into a separate agreement to recover the amount that you're paying.
That way.
Yes,
But
you will
that
have.
6% should go to the government.
Yes.
And then so some of my clients, what they are doing, they are just establishing some companies outside India, like and from there they are making the payment. Is that right way to do that?
Would that expenditure finally make its way into Indian P&L?
No, it will not come.
Then,
So they
then
are
we're
just-
good, yeah.
then
Because it
just-
applies to an Indian resident.
Okay, thank you.
I haven't told you this. Yes, equalization levy is a separate return.
The new issue between the Volkswagen and the Indian Revenue Authority, wherein they're going to retrospectively tax them for 12 years. They're like the only car makers in India who have kind of
You
imported.
can actually stand up and share the case. It will be interesting for everybody.
So recently there has been an issue between the Volkswagen and the Indian Revenue Authorities, where Volkswagen has very intelligently avoided paying, I think, around $1.4 billion taxes.
It's a GST case, I think, right?
It is not clearly mentioned, but it's about importing the, the
It's
state.
actually a customs duty case.
Okay.
It's a
So-
customs duty case.
So, like, I mean, how could they do that for over 12 years? Like, I mean, wasn't there, like, any of these legislations couldn't, is it the mistake of the, like, it's all the stakeholders are at fault, right? Because it's.
True, true. So the case you're referring to is actually a customs duty case where there was a classification mismatch, where they should have when we import from outside the country, we have to declare what classification under the HSN code that product falls into, and that HSN code determines what customs duty rate will apply. So they should have imported under a specific customs tariff, which was a higher rate of duty, but they did it under a different rate of duty. Now, two things can happen. A very valid question. Two things is Volkswagen genuinely thinks that their goods fall into this category, and they are able to probably evidence that with necessary paperwork saying this product does this function, and as a result of it, it falls into this category only. If they're able to defend that, that's good. So we cannot make an assumption that Volkswagen actually intended to evade duty. It probably could be a bona fide transaction and a belief that it actually fell into that HSN category of customs duty. Possible. Of course, it will take this whole round of courts for them to prove whether they were right, or revenue has enough evidence on their side to prove whether they were right.
Yeah,
So
but I
only
think-
court will have to tell.
Yeah, Kia was quick enough to retract.
Yes.
And like the BMW and Mercedes, they're all, following the, rule of the land. But I
Yeah.
think somehow.
Yeah, it's possible that genuine transactions could also be challenged. They are, the whole tax world, be it GST, be it customs duty, be it domestic tax, international tax, they are all interpretative. We may take a interpretation which we genuinely think applies.
Applies to
But revenue has different intentions in mind, so they would want to challenge it. So if our documentation is good and we are able to justify, we are on the right side of the law.
Thank you.
Okay, I'll quickly move to the next slide on base erosion and profit shifting. I'm not going to be spending too much time on this because there's very little that has been enacted in India in relation to BEPS. So this is a concept that is largely international, but whatever to the extent it has evolved in India, I'm going to cover it quickly, and this almost is going to be my last topic. Okay, so what is base erosion and profit shifting? So as you have seen from all the examples that I gave you, there's a lot of inclination to set shop in low tax jurisdiction to avoid tax. So what does it do to the revenue of that country? It does not get the kind of tax it should have ideally got had the treaty shopping not been the agenda of the organizations. So now to arrest this, the whole global community of OECD countries and G20 nations came together. They talked about base erosion and profit shifting as a real world problem. People are treaty shopping to avoid taxes, that is taking away the due share of revenue from the governments. So we need to take some real action to address it, and to address this because it is all pervasive. Every country is facing this treaty shopping, tax avoidance strategies. So we need to come out with a consensus-based approach where collectively we agree to a set of plans that will help us arrest this base erosion. Now, how do we do it? The whole tax world is a maze of treaties, right? Now, what we will need to do is people will have to enter into multilateral instruments to bring in the whole tax avoidance, mitigation plans. It will have to probably introduce a whole lot of BEPS initiated requirements into domestic tax law, just like India brought in the equalization levy, significant economic presence. These are all offshoots of the BEPS action project, which is like a global decision to introduce certain measures into the domestic tax law or the treaty network to mitigate the profit shifting and base erosion. So this is how the whole BEPS world emerged. So tax avoidance base erosion is at the crux of the BEPS project. So that name itself tells you the reason why it was needed, because the whole world was grappling with loss of revenue, because tax revenues is a major part of the country's finances, right? You need the taxes to pay for your GDP growth. So how do we make sure we don't lose all those taxes? So the whole BEPS action plan arose then. So two actions came out of the BEPS. There's this whole BEPS 1.0 where 15 action plans came out, and each action plan had a specific objective and a criteria. I will not go into the details of that, but there's a very high level picture of what BEPS action plan intends to do. So there are 15 plans targeted under 3 main buckets. Okay, these are the themes under which BEPS action intends to arrest the profit shifting and erosion. One is coherence. Coherence means parties to a tax transaction, countries to a tax transaction have to have coherent measures, which means if I give deduction for an expense, the other country should tax that income. You need to be in sync. So that is the objective of coherence. So a lot of measures came in through that. India did not introduce anything related to hybrid mismatch or CFC. So these are not in the Indian regulation. So we do not have to worry about it. Interest deduction, yes, India introduced thin capitalization rules. Any idea what is thin capitalization? So thin capitalization rules got introduced in section 94B of the Income Tax Act. What it says is that if a resident Indian company is taking a loan from its related party outside India, the amount of deduction that it will have for its interest that it pays on the loan cannot exceed 30% of the EBITDA. So this is also a way such that Indian entity does not take unlimited interest deduction and reduce profits in the country, right? If it was entitled to all of the interest, profit would become zero. So this is a way to mitigate that. So India introduced the thin capitalization rules under section 94B. Harmful tax practices is the action plan number 5. And here, this was a significant economic presence, which we talked about, which was introduced in section 9, is an offshoot of the coherence bucket of BEPS action plan. The next bucket or the next theme was substance, which means every transaction of cross-border should have valid substance, it should have bona fides, it should not be done with the sole intent of gaining a tax advantage. So here in these rules, I think India mainly introduced the multilateral instruments and the more stronger definition of PE under section 9. Where dependent agent PE definition was strengthened. That was one action. It did not take action on any of the other transfer pricing action plan 8, 9 and 10. What you see in the brackets are the names of the action plans. Okay, and then coming finally to the last bucket of transparency, which means that countries need to be transparent about the transactions for which it that are happening in their country in their reporting. They have to share more information. There needs to be stronger disclosure rules, stronger compliance filing rules, etc. And as a part of that, this whole country by country reporting structure came. Are you familiar with this country by country reporting under the transfer pricing regime? So the whole CBCR was an offshoot of the action plan 13, the last but one box over there on the third bucket. So all the whole CBCR, master file, etc. was an offshoot of this action plan 13. So in summary, where did India initiate action on these action plans? Is action plan 1 on equalization levy, action plan 4 by introducing thin capitalization rules, action plan 5 by introducing the significant economic presence, and action plan 7 by introducing a stronger definition of dependent agent PE. And finally, action plan 13 with the whole this country by country reporting requirements for transfer pricing. So this is the whole, I think, the evolution that I have covered from controversy to the whole development of BEPS action plans in terms of the international developments as well. So I am at the end of my slide, and I hope the takeaways that you have had from this is how legislations are ever emerging to meet pace, to be in pace with how business models are emerging. The business model we know today will not be the business model we know tomorrow. Who would have thought you could pay for like an advertisement online virtually without involving an Indian company, right? So models are evolving, tax laws need to keep pace with that. There's a need for increased transparency between nations of the data as well as by the taxpayer to the tax revenue authority as well. So the world has moved on from simple classic PE to now a BEPS world. So I hope I have covered a significant aspect of the evolution, and each of you at least have some takeaways out of it. So I will pause my session with this, and I can take any questions if you have. I can also meet you at the tea break in case you want to talk further. But that is the end of my session. So thank you very much for the patient hearing.
Thank you so much for the wonderful session and taking us through most of the latest trends in the international taxation. I request Vice Chairperson CA Kavita Ma'am to honor the speaker. Please give them a huge round of applause. Let's take a quick tea break, and let's be present here by 4:30 p.m. so we can immediately start the next session. Thank you.